This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to the latest edition of the AJ Bell Money and Markets podcast. I'm Dan Coatsworth, and joining me is Tom Sieber. Hi there, Tom.
Hi, Dan.
Now, we've unintentionally got a car theme on this week's show, covering some of the companies in the automotive industry. And there's also some important changes which could knock a decent chunk off your motor insurance bill.
Amid news that NS&I is cutting the effective rate on premium bonds from January, we ask if the saving products are still worth it.
Now, I've been celebrating ChatGPT's second anniversary by digging into the impact it's had on companies, so stay tuned to find out more.
We've got two special guests on this week's show. Cormac Weldon manages the Artemis US Select Fund, which has generated a 38% return over the past year. The US has been a great place to invest, but will it always stay this way? Cormac offers his view a little later on.
Now, we'll also hear from Polar Capital's Georgina Hamilton on the outlook for UK shares in 2025.
First up, though, let's take a look at what's been going on in the markets over the past week. Dan, we touched on takeovers on last week's podcast, and that theme has kept on going. What's happened?
Yeah, I can say that. Well, we touched on the direct line takeover approach by Aviva. So a week ago, direct line said no to what Aviva was offering. Since then, it's been quite interesting. The direct line shares been trading about £2.30 versus Aviva's offering £2.50. So the fact they're trading below would suggest that Aviva need to come back with a better offer, really, if they've got any chance of getting this deal over the line. There's been nothing at the moment, but these things can move quite quickly, and I think Aviva's statement was sort of implying it wanted to get things done and dusted fairly quickly. So it might be by the time you listen to this episode, we might have had some updates. But there have been some movement elsewhere on the UK market. So the automotive sort of components specialist TI Fluid has agreed a bid from ABC Technologies. We've had Loungers has sort of been received a takeover approach from Fortress. And there's in the mining sector, Condor Gold has been approached by Metals Exploration. So, I mean, it's quite interesting. You've got sort of all sort of the areas of the sort of market cap spectrum here, from large, mid, and to small cap stuff. So with Loungers and Condor Gold, they both effectively put themselves up for sale. Loungers, it sort of implied that the market wasn't really recognizing the value in the business and what it's achieved since floating on the stock market. So it sort of came out and said it privately held a sort of a beauty parade earlier this year, and that led to the takeover approach from Fortress. Now with Condor, going back a couple of years ago, it basically said it found and proved up a sort of a potential mine in mining resource in Nicaragua, but he said it really didn't have the skills to build a mine. It would be better owned by someone who's done this before. So hence we've got Metals Exploration that is already has its own producing assets come along and made an offer. So this sort of takeover theme does sort of seem to truck along, and while the UK market is trading still fairly cheaply, I expect the takeover thing to continue into 2025. I was actually having a look at the market for a few obvious candidates of names that really good businesses whose share prices either sort of stumbled for sort of short-term issues, or it's just or simply the share price is going nowhere and it hasn't done for years. And I can see a few ideas, but I'm going to save those for a future podcast.
Nice tease.
Yeah. So obviously we don't want to give you all the good stuff now, but no. we'll have that soon. Perhaps in the coming weeks on it.
I mean, I guess one thing to note is that the shareholders might be pleased in the short term if they get a takeover at a premium, but for the wider health of the market, this continued sort of shrinking of the UK market is not necessarily good news long term, is it?
No, not really. I mean, it's frustrating. We are expecting an increase in the number of companies joining the stock market from next year. But until that happens, it sort of replenishes the pot, so as to speak. We just have to sort of sit back and see, one by one, the market sort of being picked apart. So
Before we finish talking about takeovers, I wanted to ask you about US Steel, as its takeover seems to have hit a bit of a stumbling block.
Yeah, I mean, this is so this is Nippon Steel has offered $14.9 billion to acquire US Steel. This is not new news, but essentially Joe Biden and the Vice President Kamala Harris both have sort of expressed opposition against the deal, seeing it as a threat to national security, job security, and such. Essentially saying that American business should stay owned by American ownership. Donald Trump has now come in and says that he will block this takeover as soon as he gets into power, and so I think it's sort of this could set the tone for more things. It's clear that Donald Trump has got this sort of view that he thinks obviously his America makes great again sort of slogan, that things that are of strategic importance to the US economy should not be owned by foreigners. I mean, but there are some sort of concerns here that a Japanese company owning US Steel could pose threats to national security, lead to job cuts, relocate workers to non-union states, and so on. So I think obviously this is still a live scenario at the moment, but I think what we'll find increasingly, big takeovers could find intervention by governments, and that does apply to the UK as well. There's certainly been a few sort of murmurs like what would happen if there was a proper bid for BT, what will happen for the oil company BP if that was bid for, things like BAE Systems, the defense side. Get yet another thing for everyone sort of listening to this podcast to perhaps to keep an eye on. I think it will be a growing trend. But let's move on to another sector. So I said at the start, we've got quite a big car theme. So let's move on to this automotive sector, because it does seem to be experiencing more twists and turns than a B road in rural Wales, doesn't it, Tom?
It does, yeah. And at this point, I think we should point out that neither of us are massive petrol heads, but it's been pretty hard to ignore what's been going on in the sector recently. So offering a bit of context, all of the big automotive players in the West have been struggling increasingly with the transition to electric vehicles. There's been sort of stumbling blocks to the mass adoption of electric vehicles. One, because of the price tag and the number of options available, and also due to range anxiety. So people worrying that they won't have sufficient charge to get where they want to go. Now, in China, it's been a bit of a different story. Manufacturers have been able to manufacture electric vehicles much more cheaply than Western counterparts, and therefore have offered more affordable electric vehicles to a domestic audience, and they're starting to move outside of China as well. And as a result, there's sort of two things from that. So one is that EV adoption in China has been much greater, but also that big Western brands have found life pretty difficult in China because of this domestic competition. Which brings us on to Stellantis. So this is a company which owns several well-known car brands. So you've got Fiat, Citroën, Peugeot, Vauxhall, Chrysler. And they've just run out of patience with their chief executive, a guy called Carlos Tavares. And I mean, he's quite a respected name in the industry, but given how long Stellantis shares have been stuck in reverse gear, the fact that he's going isn't a huge surprise. He's been in charge since the business was formed. So in 2021, Fiat Chrysler and Peugeot owner PSA merged, and that created Stellantis. And the business has had a very tough time. It warned on profits, partly thanks to China, but also due to kind of bloated inventories in North America earlier this year. So, like I said, it's not a massive surprise that the chief executive has gone. There's been some interesting headlines around this company and the UK as well, which kind of feeds into this electric vehicle story. So they blamed a recent decision to shutter a van factory, Vauxhall van factory in Luton, on how stringent the EV rules are in the UK. And going back to what I was saying at the beginning, it's this big regulatory push to shift into electric vehicles when at the same time there isn't necessarily sufficient demand, which is creating real headaches for the sector. And looking at the rules in the UK, there isn't just an ultimate deadline at the end of this decade for an end to sales of traditional combustion engine vehicles, but also an incremental increase starting from this year, which mandates what proportion of vehicles sold by manufacturers have to be electric. Now, it does look like governments are starting slowly to recognise the issues the sector is facing and to delay some of these rules. So the UK government has signalled plans for a consultation, which might water things down a bit, potentially allow hybrid vehicles to remain in play alongside electric vehicles, at least for a number of years. But whatever happens there, I think it's fair to say that whoever takes over at Stellantis, which is, I think they've said that they'll kind of look to a point in the first half of next year, is going to face a real challenge to get the business and its share price motoring again.
Now, obviously, we're talking about cars and electric vehicles, so it kind of wouldn't be a regular week if we didn't have some comment about Tesla and Elon Musk. And lo and behold, this man is back in the news again around his pay package. So, Tom, what's been happening here?
Yeah, so people might already be familiar with the basis of this story, but just in case, and it's been rumbling on for quite a while, but just in case, I'll go back to the beginning with it. So this actually relates to remuneration for 2018. So these were stock options tied to a series of financial and market valuation related targets, and their value when they were voided. So there was a ruling in a Delaware court in early 2024. The value of these stock options was $56 billion. So absolutely enormous sum. In fact, the theoretical value of them now is actually a fair bit more, because Tesla shares have done particularly well in anticipation of Trump being elected and post his election, thanks to Musk's closeness to the incoming administration. What's happened most recently is that the same judge who rejected the package or ruled that the package couldn't be awarded in early 2024 has done the same again. And this judge, Kathleen McCormick, is citing the same concern she did at the start of the year, which is that when the award was made in 2018, there's serious question marks over just how independent the board which agreed to it was, how much influence Musk had over them. And she made the ruling despite the fact that shareholders actually voted to approve the enormous pay awards back in June. Now, Tesla is likely to appeal. Musk has sort of been on record as saying, it should be up to shareholders, not to judges, kind of how much he gets paid. There is maybe an argument that this isn't just about money, but also about his control of Tesla. So if, potentially these options could take his holding in Tesla from current 13% to 20%. And he's said without, his stake being increased, he might be tempted to walk away. So given this appeal, it's pretty likely this, very long-running saga will rumble on into 2025. Musk's role in the incoming Trump administration and the influence that might grant him, he might hope that'll give him a chance of getting this overturned. And it's fair to say the irony of someone tasked with increasing governmental efficiency under Trump pursuing what looks on the outside like a wildly excessive pay package isn't lost on me, at least.
Yeah. Should we have our first guest on the podcast now?
Absolutely. So Dan recently did a road trip of his own. He met a wealth of fund managers specializing in different parts of the world, and we've now got the final run of interviews with these people. There has been a lot of investor interest in the US in recent years as the stock market keeps going. One person who knows all about this part of the world is Cormac Weldon from Artemis, and he's got some really interesting things to say about the US from an investment perspective.
I've got Cormac Weldon from Artemis US Select Fund and US Smaller Companies Fund. So Cormac, thanks very much for joining us.
Not at all, thank you.
So we just had the US election results. Stock market jumped on Donald Trump's victory. But I thought it's quite interesting how the stock market jumped, because his policies could drive up inflation, could keep interest rates higher, relatively higher for longer. Why didn't the market fall on that news?
Yeah, so what you said is absolutely true. So interest rates could stay higher for longer. The policies of tariffs could be inflationary, obviously, depending on to what degree he does or does not actually end up enacting tariffs rather than using them as a threat. But I think it was the other side of the equation. So first of all, if Kamala Harris had been elected with a sweep in the way Donald Trump has, winning both houses of Congress, taxes would have gone up a lot. So the alternative was corporate taxes going up a lot, being a less business-friendly environment if Kamala Harris had won. On the other hand, we pointed out the downsides of Trump in tariffs and possible inflation. The positive is his urge to deregulate and tear up red tape. And it sort of sounds odd as to why that would be particularly positive, but we know from the first time he was president that small business confidence shot up and remained at pretty high levels right through until COVID. And that's because, small business owners don't want to be regulated, don't want more red tape, want confidence in, if I make this investment, I'll be able to keep all of the returns or whatever it may be. So I think it was those factors, as well as he is talked about cutting corporate taxes as well. Now, I think he admits he won't be able to cut them all the way down to 15%, but a cut in corporate taxes would be positive for companies as well.
I mean, you're certainly the US Select Fund's got lots of the big mega cap tech stocks. What is Trump good for the tech sector?
I think it probably indifferent, really. I mean, so he's not going to do anything special for the tech sector, although Elon Musk may benefit in some ways. But the tech sector has its own dynamics going on, right? AI is a huge investment theme that US companies are pursuing with gusto. We do know that both the Biden administration, but also people he's already nominated, that Trump will be positive towards AI investment. He's also positive, we believe, towards just any sort of investment that companies are making. So, for instance, we're hearing talk that he may cut or provide a bonus for capital investment to companies who invest in the economy domestically in the economy. So from that point of view, we think it could be less benign than we thought, or less harmful than his rhetoric about metaverse and all of that. I think we can just file that in Trump rage stuff that actually won't result in anything concretely negative.
Yeah, I mean, all the tech stocks seem to sort of respond positively when the election news came out, apart from Meta, which had a bit of a wobble. I mean, Trump hasn't been very favourable towards that company, but is it a case of like it's all talk? And nothing really bad coming that way for that company?
Well, let's see. So, and how might the bad come? Would be through regulation? Would be come through the Department of Justice or the Federal Trade Commission? We're pretty confident that the leader of the Federal Trade Commission will be a more benign impact on corporates in general. So that, from a Meta point of view, we think will be won't have a significant impact. We don't believe under a Republican presidency that companies will be forced to split up, for instance, which might have been a potential risk if Kamala Harris had won, and Meta might have had to divest Instagram or something. But yeah, so I don't think so. And you know what? The large tech companies are handling Trump better than they used to. So there was a podcast that Mark Zuckerberg did, and he talked about Trump being a warrior or something like that. I mean, they understand that flattery will probably get them somewhere with Trump.
I mean, Trump is not the biggest fan of China, to put it mildly, and he, clearly with the threat of like 60% tariffs on goods from China into the US, the relationship is probably going to get even worse, isn't it? But so obviously there's talk that China would like to take ownership of Taiwan. Taiwan is such a central, important supplier of chips into the big US companies. So Apple, Nvidia, they're all clients, aren't they? If you it seems like a very complex maze where US-China relationships potentially could see Taiwan at the middle of this and actually have a terrible impact, worst case scenario, on not just US tech companies, but globally, the stock markets, couldn't it?
Yeah, and this is where there's a lot of unknowns, right? You're absolutely right. It's very easy to paint quite a negative outcome to Chinese invading, taking over, controlling Taiwan. I mean, and again, this is where we who operate in financial markets maybe shouldn't make this assumption. But one assumption we could make would be China would still like the billions of dollars that TSMC makes, and not shut off that massive source of revenue that TSMC in particular provides to Taiwan. But yeah, we don't know. We don't know. I think to assume the worst possible outcome is probably just not in the range of outcomes, is probably not the one to focus on all of your dollars, but it is certainly worth bearing in mind the potential risk. And what's the benefit? In what way might we benefit? Well, it probably will see an intensification of investing in the semiconductor industry in the US. Now, it'll take an awful long time to replicate Taiwan, so we're not saying in a year's time they'll have done that. They won't have, but we will see, I think, that balance being redressed somewhat with greater investment in the US.
I think anyone who's invested in US equities over the last 15, 20 years generally it's been a really good place to invest. Obviously, a big chunk of that was when interest rates were very low. I guess the big question is, will US shares continue to be such a good place, or because there must have been times in history when it's not done well.
Sure. Yeah. No. There certainly has been. So the U.S. equity market is today in a very unusual spot compared to. I think it's probably fair to say compared to any equity market ever, and it's this. We do have a cohort of exceptionally profitable high growth companies. Now, usually those two phrases don't go together. If you're growing fast, you probably need to invest a lot of money to grow, which means your current profitability is hampered. And on the other hand, if you're very profitable, it's probably because you've slowed down investment and you're just you're milking the profits. The US has about 200 companies. Some strategists sort of have a bucket of 200 companies that are entirely exceptional. They're much more profitable than any other cohort of companies around the world, and they're growing at a much faster rate. And it's not just the big tech companies. It's restaurant companies, it's healthcare companies. It's really companies that are the result of innovation and at some point in their life venture capital investment. Whether it's healthcare or technology would be the biggest areas, but it's money going to invest in someone who has an idea that might become a product or a service that might become a company and that might come in public on the public market. So that is a difference that the US has over every other equity market in the world. So the question is that sustainable? We'll see. But what we would say is over the years, some companies are in that group of companies, but then fail, but other companies come out. So we do still think the backing of that venture capital investment, which remains today, will continue to seed the future growth companies for the next 10, 20, 50 years. So we think that is likely to continue, and therefore, the U.S. equity market is probably tied somewhat to those companies continuing to succeed. Where we would look for risks would be regulation, would be an obvious one for big tech. I mean, we've referred to it already, and the attitude to metaverse and others. But at the moment, that's more benign than we expected, actually.
Yeah. So, I mean, obviously, what about just moving into 2025? Are you obviously a big change for the US, but I mean, how are you feeling? And just from an investment perspective, you think start the year in a fairly positive tone?
Yeah, I'd say certainly. I mean, the promise of the early promise of the Trump presidency would be that he'll go to cut taxes relatively quickly, and that he'll start, talking about and actually cutting red tape, and that should help sentiment in the equity market, which admittedly is already pretty positive and thinking about those things. Our earnings growth should be quite strong. We think around 10% next year, so that's pretty positive for the market. But I do think we've to acknowledge that some of the very large companies have done very well, have become more expensive. So they've not only grown and got bigger, but they've also become more expensive. So what we would expect is perhaps a broadening of those companies doing well in the market. So not just big tech. And we've already seen, some financial companies doing well, industrial companies. We should remember that there's trillions of dollars being invested in US infrastructure, for instance. So those companies we would expect to do very well, cement companies, engineering companies that build buildings, all of that sort of thing. So there's plenty of other areas that have not been re-rated higher and are not very expensive that we think will benefit from investment.
Well, Cormac, thank you ever so much for coming on the podcast. It's been fantastic to have you on.
Thank you very much.
Thanks to Cormac Weldon from Artemis for sparing the time to talk to us on the podcast.
Right, let's talk motor insurance. And, you might be thinking, okay, here we go. Another bad news story. My policies are going up. But actually, it's good news, isn't it, Tom?
It is, yeah. Good news for the insurers themselves, which in turn might translate into, or looks likely to translate into good news for motorists too, who I'd noticed that RAC figures confirmed this week are set to enjoy the cheapest Christmas petrol prices since before the pandemic. So a wealth of good news for motorists recently. But the story relates to something called the Ogden rate, which I'd imagine most people aren't familiar with. But this is something used by courts as a kind of an assumption when they're determining how much compensation toward victims of car accidents and other personal injury and other people caught up in personal injury cases. And it's basically trying to work out the level of return they can expect to generate on any money that's paid out when it is invested. So the higher the rate, the lower the lump sum that will be required. And the plan is for a new discount rate of 0.5% to come into force from a previous rate, which is actually negative. So it's minus 0.25%. So to put that in kind of simple terms, say a claimant won £1,000 in compensation from an insurer under the old rate, they would have received a little bit over £1,000, and under the new rate, they would receive £995. And obviously, if you extend that over multiple cases, it does make, a fairly significant difference to the profits of motor insurance companies. So there's been some analysis from accounting firm PwC, and they've estimated that premiums could decrease by an average of £50. Given that this is going to reduce at least one area of pressure on the sector. And, obviously the sector has paused through, some pretty chunky increases in premiums over the last couple of years anybody who owns a car would be well aware of that. And it's worth remembering, despite that increase in premiums in recent years, this is a competitive market. So there's a pretty good chance you can see why PwC think, where they get their sums from, because there's a pretty good chance companies might take the chance to cut prices thanks to this change.
So thanks, Tom. That's a welcome bit of good news on the insurance sector, which we don't often get.
Absolutely. Now, we might be just a few days late, but did you know that ChatGPT has just celebrated a birthday?
Yeah, I mean, it's quite remarkable. It's only 2 years old. I mean, I find it hard to recall another bit of technology that is so early into its lifespan, yet it's had such a profound impact on businesses and consumers as ChatGPT. So, obviously, it might be that lots of people listening to this podcast, they might be familiar with the name and not quite sure what it does. Kind of started out as a chatbot, and it's become sort of a much bigger beast now. But ultimately, it's made a really big impact on companies that have a large workforce in customer services. So we've seen lots of people think that they're talking to a real person, say, for example, via an online chat system. They want to, they're going to sort of like a retailer or a telecoms provider, ask a question. But in reality, they're actually interacting with this chatbot. So, to give you some examples, KLM, Royal Dutch Airlines, has been using them to help passengers manage bookings and answer travel-related queries. Klarna uses sort of the buy now, pay later thing. Actually, this is going back to this is in February, so this is just over 1 year of ChatGPT's existence. It said that its AI-powered assistant was doing the equivalent work already of 700 full-time agents within its first month of being used. But really interesting is that customers are getting their queries answered faster, but also it's seeing a 25% drop in repeat inquiries, which suggests that customers are getting the information that they need at the first point of call. So incredibly powerful here. Of course, this raises questions as of thousands of people lost their jobs because of it. I think if you ask quite a lot of these companies, they'll say that they've redeployed staff into other parts of their business to do different things. What we are seeing is sort of the broader generative AI is a sort of a term which ChatGPT fits under, but we're also getting really rapid results here with other sort of things called co-pilots, like companion software, where it's more tools to enable workers to be more productive. So there's a really good example of a law enforcement technology company called Axon announced this new system called Draft One. So it's an AI-powered software. Essentially, it takes body cameras that policemen are wearing, sort of takes all the information that they're seeing, and it can automatically produce reports. So it saves officers so much time. If you think about one of the big sort of demands on sort of people in the police force is to go back to the office and write up these reports. Well, this now system is to can essentially do most of it for them in a sort of a click of your fingers. So it's incredible. So I think we've heard this year all about companies like NVIDIA, who are providing chips to help process all this information to power AI systems. I think next year you're going to hear a lot more about companies who are actually using AI and the profound impact it's having on their business. I mean, Meta, the owner of Facebook, that's already been talking about how it's improved engagement on its platforms. It's becoming a lot better at serving up the type of sort of videos that people like to watch, and it keeps them engaged for longer. And so the more time they're spending on these social network platforms, the more adverts they're being served. Of course, the more money that Meta's making. So there's plenty of really good examples here, and I think we're going to get a lot more. But it's worth pointing out there are some downsides to these sort of Gen AI systems. Hackers are using them to create convincing phishing emails. Some areas like the drug discovery banking industry, that they were expected to be sort of major users of it, but haven't seen sort of really big results yet. And it's also putting a lot of pressure onto infrastructure providers. And there's lots of fears that AI data centers are actually sort of facing capacity constraints. But it's clearly a really big theme. We've talked about it quite a bit on the podcast, and I think that you'll see the shift in the new year towards people saying, "Okay, show me the results. How is this really benefiting you?" So, I mean, I am still absolutely fascinated by it, Tom. Obviously, you from your perspective, writing in Shares Magazine, you must have spent many column inches on this sort of topic.
Absolutely, yeah. And I agree with you that I think it will definitely be about a shift next year to sort of both looking at how it's kind of got real world applications, but also a lot of the beneficiaries in stock market terms have been on the hardware sides, and what the market is maybe looking for more evidence of is how kind of software companies can benefit in terms of applying it. And there was an interesting set of results this week from Salesforce, where they were making a big play of this new kind of agent. So a bit like Copilot, Salesforce is a really dominant name in customer relationship management, and this Agent Force product that they've launched in October, they've apparently seen kind of very, very significant take up of. So I think you're right. I think AI is still going to be a big theme. It's just going to be sort of perhaps a slightly different skew to it in 2025.
Well, there's one thing that I'd love ChatGPT to tell me is when I'm going to win the premium bonds, because so far I've had absolutely no luck.
Yeah, I'm afraid I've got bad news for you there, Dan. So I know that AJ Bell put in a Freedom of Information request earlier this year, which found out that actually 2/3 of holders have never won a prize. I mean, if you don't own that many, then that definitely decreases your chances of winning. So, I mean, I think they're very popular products, so I'll only be brief on it. But just in terms of how premium bonds work, premium bonds are entered into monthly into a lottery draw, but they're not guaranteed to earn any interest. And some of them, you could win a maximum of £1 million, but just like, the national lottery, it's very unlikely that you will do so. And the reason I say there's been sort of bad news on this front is that National Savings and Investments, which administers premium bonds, has been cutting rates. So not only on premium bonds, so it's cut rates on its 3-year and 2-year guaranteed growth bonds from 4% to 3.5%. and from 4.1% to 3.6% respectively. It's announced some similar cuts to its guaranteed income bonds from 4.02% to 3.54% for 2-year fixes, and from 3.93% to 3.44% on its 3-year product. And going back to premium bonds, the premium bond prize rate dropped from 4.4% in November to 4.15% in December, and it's set to drop further to 4% from January. Now, one big part of the appeal, I think, of premium bonds is they're backed by the government. So people feel very reassured having their money in them. But of course, all of us do benefit from an £85,000 financial services compensation scheme protection. And there are higher rates available on fixed rates savings accounts elsewhere. So I had a quick look at the Money Facts website, and I think according to them, the top 2-year fix is 4.6%. So the arguments, I guess, for holding premium bonds, they just got a little bit worse or a little less convincing over the last week or so.
Brilliant. Well, thanks, Tom. That's really interesting.
So we've got time for one more segment on this week's podcast, and it's a fund manager talking about the UK.
So here with Georgina Hamilton from the Polar Capital UK Value Opportunities Fund. Hi, Georgina. You okay?
Good morning. Yeah.
Thanks for joining us. Now, we've got some political clarity following the general election and the budget. Finally, is it enough for a major turning point for UK shares? If so, why do you think that is?
Well, I think that the UK election was really important. It has, after years of political turmoil in the UK, meant that from here, political uncertainty is much reduced. And that's in stark contrast to what we're seeing in Europe, with some elevated political volatility. There's very polarised politics in France. There's a very tricky three-party situation to resolve in Germany, and some far right being involved, being elected across Europe. So taking that all in the round, I think the relative political position of the UK is much improved, and I think that's important for lowering the risk premium that had been attached to UK shares, and therefore lowering the cost of capital of UK shares, and that will help with the re-rating. But coming on to the point about the budget as well, that's also been at the margin probably helpful because it's led to near-term GDP upgrades, and that should help earnings growth in the UK, and that should also feed through and help a re-rating. But I think if we take a step back, actually the turning point in UK equities sort of started at the beginning of the year, the beginning of 2024, because there's twin issues that the UK has been facing, which is a higher cost of capital and deteriorating profit expectations have both started to turn around at that point. We've already had forward rate expectations come down. We've had 2 rate cuts. We've had GDP upgraded since the spring. So I think some of those components were already in place before these events.
On the subject of the budget, I was just wondering, was there any bad news in there? I mean, certainly the employer national insurance changes seem to be a bit of a headwind for companies.
You've absolutely struck on the key point for corporates, at least, which is this big NI hike and the attachment point at which the NI starts to hit. And I think there's also been a layering of changes, employment changes. There's been a hike in the national living wage alongside this NI, and then there's changes in employers' rights on top. So it's a complex picture, but I think it hits the biggest employers the most, thinking hospitality, retail, supermarkets. We don't have too much actually in that area. We've marginally reduced our Sainsbury's, but we don't have too much direct exposure to that. Where we do have exposure is actually what was positive from the budget was in infrastructure. So they've raised a lot of money across the whole economy and they're putting it into mainly infrastructure. And we have around about 13% of the fund in infrastructure. And I think that will really see a benefit in the coming years. An extra 24 billion is supposed to be spent there.
I mean, this idea of a re-rating in UK equities, shares trading on a higher multiple of earnings than they are currently. People have been talking about this for many years. It's not simply sort of, I know sentiments is slightly improving this year, but the idea of a re-rating. Now, we've had takeover activity, so clearly someone is recognised there's value in the market, but generally, UK shares are still really so much cheaper than many other parts of the world. Why is it that's still keeping it depressed? Well,
I think that gets to the heart of the point, because it's difficult to talk about when UK shares are going to come back until you've really got to the bottom of why they've suffered such a multi-year derating that you've highlighted there. And I think there were 2 issues which has prevented the re-rating of UK shares for a number of years, and that is an elevated cost of capital. And also, frankly, and it's perhaps a bit less talked about, that deterioration in profit expectations has gone on as well. And I think that we have seen turning points there, certainly with forward rate expectations in 2023 were to get to 6.5%. And we never got there, and we're now getting rate cuts. So that's beginning to reduce the cost of capital. And then on the earnings side, we've had, following big issues with negative real incomes and negative consumer confidence. Consumer confidence has gradually improved. We've got real income growth now and GDP being upgraded. And as we look to 2025, we should be the 3rd fastest growing country in the G7. That came from basically last. So it's quite a big change that we've had there in the growth side. I think what we're seeing at the moment, so far what we've seen, is that pockets, if you deliver well in the UK as a UK company, you are now being re-rated. And I think that's the start of a process whereby these issues are being put to bed and the whole market can re-rate from here.
So I mean, so from a sort of positive perspective, where are you seeing the best opportunities at the moment now?
We see particular opportunity in the mid-cap space, and that benefits from, talked about this rate cutting cycle, and mid-caps tend to do better after rate cuts have been initiated. Also, it's seeing the M&A activity that you've highlighted. I think 10 out of the 11 bids so far this year have in the 350 have been in the 250. 23 billion out of the 30 billion of M&A has been in the 250, and that amounts to, which I never thought I'd see in my lifetime, 9% of the 250 being bid for. Wow. And the by value, and the premium is 44%, and that's the really interesting bit. These are shares that are going at good prices. And I think it'd be a different debate if they were, growing below our intrinsic value that we saw, or 10% below book value. But that's not what we're seeing. These are good, healthy premiums. So I think there's more M&A in the 250. They benefit more from the rate cutting cycle. It's also cheaper relative to its history, the 250, than the 100. And finally, I think it benefits more from that domestic earnings exposure, that real income growth that's coming through in the UK. That benefits more the mid cap. But when it comes to sectors, we've got decent exposure, not just to infrastructure, which we talked about, but domestic banks and other financials, and then other areas in consumer and REITs.
I mean, just on the subject of takeovers, obviously, some of these companies have been taken out for a decent premium to their market price, but that means that the pool of companies left on the stock market is shrinking. But we're not getting the same amount of companies, new companies join the market, these IPOs, the initial public offerings. But there are some changes to the listing rules that kind of make it a bit more relaxed. I think the intention is to try and make it a bit more appealing to companies thinking about listing. Do you think, have the rules sort of, are they lenient enough, or do you think actually it's not really going to make too much of a difference?
I think that it's helpful. We have already begun to see some good quality, and that's the key, actually, good quality IPOs coming to the market this year. The likes of Raspberry Pi, Applied Nutrition, these are really high quality companies that have come. And the reason why I talk about that is that 2021 saw a vintage which I think the UK market would quite like to forget of IPOs. So I think the door is open because they've gone and jumped into it, out of it, whichever way around. But they've seized that opportunity. I think what will drive IPOs from here is the IPO cycle, that pipeline of deals. I think it looks better for 2025 than it did for 2024. And I think these changes help, particularly where there's founder-led businesses. But I think it will be dictated by bigger issues in terms of pipeline and financing rates.
I mean, what's sort of the magic ingredients you look for you to actually press the button and actually go ahead and buy a share?
We have 3 magic ingredients, and that is, first of all, you have to be cheap. And we see 2 types of cheap shares, our bargain asset shares and our cheap value creators. And our bargain asset shares are shares that trade below tangible asset base, so you can flog all of the assets for more than the price on the screen. That would be your deep recovery type shares. Then our cheap value creators are ones where the returns on invested capital, the future profit stream, is underappreciated by the market. But we feel that being cheap is not enough. So that's why we have a second and the third part of the process. And I guess it's another way of saying that we've got 2 extra criteria to avoid value traps, which is the key problem in value investing. So when it comes to our bargain asset shares, we need a durable asset base. So if you see £1 worth of assets, no matter how cheap the shares are, they can be trading at 60p. We don't want that pound of assets to go 95, 90, 85. It's very difficult, even if you're cheap, to re-rate into that. And then with our cheap value creators, where we're looking at the profit stream, we don't want the profit stream being downgraded, going backwards. We don't want deteriorating profit stream. So durability is that second part of the process. And the final part looks at the funding position, the balance sheet of the companies we own, because at its simplest level, we don't want a company to go bust before we realise the value that we see there. And we have something called our safety check, and that is a very stringent way, we believe, to look at balance sheet and funding, where you need to be able to de-gear all of your debt from retained cash flow inside 10 years.
Well, what would sort of make you sell a share? Is it sort of a re-rating valuation or something gone very wrong with the company?
So we essentially, if you fail any 3 of those criteria, then we'll exit. So one of those could be, as you've pointed out, you re-rate all the way to target price and we sell you at target price. Sometimes the target price is static because we saw £1 of assets and that's what it is. But sometimes, imagine the profit expectations have moved on and improved. We could have moved the target price up. But once you do hit the target price, we exit in full. But we also exit if either the profit deteriorates, that fails the second part of the process, or if the balance sheet deteriorates and fails our safety check. So it can be any one of the 3. And I think it's important in fund management, you've got to stick to your knitting. You've got to say that if the premise under which you went in is no longer valid, then you have to admit your own mistakes. And I think that we find we have good data that when we move on from these shares because they fail the second and the third part of the process, on average, that does work for us. So we have the confidence to do that.
Well, fantastic. So Georgina, thank you ever so much for joining us from the Polar Capital UK Opportunities Fund.
Thank you very much.
Thanks to Georgina for talking to us, and thanks to you all for listening. That's all from us this week. Don't miss next week's show, where Dan will be talking about Lemsip and Guinness with 2 investment experts from 91. And I'll be talking to Impact's environmental markets. Thanks for joining us.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.